Lesson 2, Risk and Return. By the end of this lesson, students should be able to analyze the expected return and standard deviation of a security, discuss the concept of risk tolerance, and understand the concepts of utility and certainty. In the last lesson, you learned about holding period returns. Historical holding period returns can be easily calculated based on actual data. However, projections or speculation about the future is clouded by uncertainty. The past can certainly be used as a proxy for what might be expected, but even that is unreliable for accurate projections. Because of the uncertainty, an expected return is based on probabilities and return expectations of possible outcomes. The formula that you have seen before in Business 591 for expected return is the expected return equals sigma P sub s R sub s, where P is the probability of the scenario and R is the expected return of that scenario. Let's look at an example for a quick review of expected return. What is the expected return given the following data? In a bull market, the rate of return expectation is 40%, and the probability of the bull market occurring is 30%. A neutral market has an expected rate of return of 15%, and the probability of a neutral market is 40%. And the bear market scenario has a rate of return expectation of minus 15% and a probability of occurring 30%. A security's expected return is the sum of each scenario return that has been multiplied by its probability. In other words, the expected return is the sum of the weighted scenario returns, where the weight is the probability of the scenario occurring. In this example, the bull market expected return is 40%, and the probability of a bull market happening is 30%. 40% times 30% means a weighted scenario return of 12%. The expected return in a neutral market is 15%. The neutral market is anticipated to occur 40% of the time. 15% times 40% yields a weighted scenario return of 6%. In the bear market, the expected return is a loss of 15%, and it is anticipated to occur 30% of the time. Minus 15% times 30% equals minus 4.5%. The expected return of all expected outcomes is 13.5%, i.e., 12% plus 6% minus 4.5%. Risk is the chance that the expected return will not be realized. Variance or distribution of returns around the expected or mean return is how risk is usually quantified. The equation for variance that you have studied in Business 591 is sigma squared equals the sum of P sub s times R sub s minus R hat squared. Standard deviation is the square root of the variance. This statistical measure normalizes the return around the mean. Let's look at standard deviation in some more detail. This statistical measure normalizes the distribution around the mean such that 68% of the time the actual return will be plus or minus 1 standard deviation. 95% of the time the actual return will be plus or minus 2 standard deviations. And 98% of the time the actual deviation will be within 3 standard deviations. Consider the following example. A security has an expected return of 15% and a standard deviation of 5%. That means that 68% of the time you would expect the annual return to be within a range of 10 to 20%, i.e. 15% plus 5% standard deviation equals 20%, and 15% minus 5% standard deviation would equal 10%. 95% of the time, you would expect it to be within the range of 5 to 25%, i.e. 15% plus 5% plus 5% equals 25%, and 15% minus 5% minus 5% equals 5%. Standard deviation is a good measure of risk for normal or symmetric distributions. But what happens if the distribution is not normal? What happens if the distribution is skewed or exhibits long tails to one side or the other? In those cases, the analyst may look at alternative risk measures, like lower partial standard deviation or value at risk. Let's quickly review the variance and standard deviation calculations you covered in Business 591 by examining the following problem. Question: what is the variance and standard deviation given the following data? The bull market, rate of return 40%, probability 30%. The neutral market, expected return 15%, probability 40%. And a bear market, expected return of minus 15%, probability 30%. You already know that the expected return is 13.5%. The variance is discovered by squaring the difference between the scenario and expected return. In the bull market scenario, the square difference is 7.02% or 0.0702. Multiplying that by the scenario probability of 30%, you get a weighted scenario variance of 2.11% or 0.0211. Following the same procedure for the neutral and bear market scenarios, you get 0.01% and 2.44% respectively. Adding up the weighted variance for each of the three scenarios, you get a variance of 4.55%. That translates to a standard deviation of 21.34%. Modern portfolio theory confirms that rebalanced, diversified portfolios investing in assets that are liquid can be described by normal distributions. That means that the mean, i.e. the expected return, and the square dispersion of returns around the mean, i.e. the variance, are sufficient to describe the distribution. Here you see the mean returns and standard deviation of several asset categories over a 70-year period. The geometric, arithmetic returns are given along with the standard deviation. Later in this course, you will learn how these statistics are useful in assembling optimal portfolios. As you have already learned, risk is the possibility that you will not actually earn the expected rate. In efficient markets, investors demand a risk premium to take on additional risk over the risk-free rate, i.e. the U.S. T-bill. This concept is summed up in the Wall Street saying, there is no free lunch in the market. The higher one perceives the risk to be, the higher the premium it will take in order for one to take it on. Another way of thinking about it is for a higher level of risk, an efficient market demands a higher level of expected return. The formula for the risk premium is risk premium equals the expected return of the market minus the risk-free rate. this example, the expected return of the market is described by a simple binomial model. 70% of the time, you would expect a return of $125 on a $100 investment. In other words, you expect that you will earn 25% on the investment 70% of the time. 30% of the time, you expect to experience a loss. In this example, you expect to lose $20 on the $100 investment, or a minus 20% return. The expected return of these two outcomes is 11.15%. If the US T-bill is yielding 5%, then the market premium for holding this risky asset is 11.15% minus 5%, or 6.15%. The concept of risk tolerance is used to explain the behavior of investors when facing uncertainty. Consider this payoff scenario on a $50 bet. A sure payoff of $45, a 50-50 chance of $100 or 100, where the expected payoff is $50 or a fair game, or a 60-40 chance of earning $100 or 0. The expected payoff here is $60. The risk-averse investor is a person who rejects any fair game, e.g., $50 bet for a $50 return, and prefers either a risk-free payoff or a potential return that compensates them for the level of risk assumed, for example, a $60 payoff. The risk-neutral investor is willing to accept a free game, i.e. a $50 payoff for a $50 bet. The person is indifferent to placing the bet or not placing the bet, even when the payoff is a fair game. The risk-loving investor takes on the bet for the pure love of the action, and the payoff is not the motivator. Let's focus for a moment on the risk-averse investor. Can a speculator or gambler be risk-averse? Yes, they can, if they demand an adequate payoff for taking the position. Professional stock traders often refer to this as upside potential versus downside risk. Question: would you be willing to take a speculative position in a stock or trade a system where there is an upside potential of plus 2.5 times the dollars you put at risk, a downside risk of minus 1 times the dollars you put at risk, and an expectancy that you'll be right only 34% of the time? Some of the most successful investors in the world do. Let's run the numbers. The expected return of the stock trade can be described with a binomial pricing model. If you put $1 at risk, you anticipate that 34% of the time you will earn a profit of $2.50 on the investment. In other words, your expected payoff is $2.50 times 0.34, or 85 cents. 66% of the time you expect to lose the entire $1 you put at risk. The cost of this scenario is expected to be 66 cents. In this example, your expectancy is a plus 19 cents over time. If you make 100 trades with an anticipated profit of 19 cents per trade, you earn $19. $19 divided by $1 times 100 trades equals a 19% profit. Is that payoff enough for you, the risk-averse investor? Would you require a higher upside to downside relationship? Would you need a better win-loss expectancy? Those questions lead us into a discussion about utility. The concept of utility measures the amount of subjective satisfaction or welfare an investor assigns to a decision in the face of uncertainty. As such, Utility helps to describe an investor's decision-making process for investing their money. Daniel Bernoulli, a Swiss mathematician, introduced the concept of diminishing marginal utility, i.e., an additional utility compared to each additional dollar, when suggesting a solution to the St. Petersburg paradox. His position was that the increase in utility of an outcome is not directly proportional to the dollars of outcome. Rather, the utility increases, but at a decreasing rate as compared to the benefit. For example, the utility of $1 extra for someone with $100 total savings is greater than the utility assigned for $1 extra by someone with $1 million in savings. The utility score is an attempt to rank alternative investments. Here is one example of a utility scoring system. The utility score equals the expected return minus the product of 0.005 times A times sigma squared, where A is the investor's risk aversion and sigma squared is the variance. What does the utility score ER minus the product of 0.005 times A times sigma squared mean? The utility score describes the relative risk-return profile of the investment. The higher the calculated score, the more desirable the investment for the investor. ER equals the expected return of the investment. 0.005, this is just a scale that allows expected return and variance to be put in as a percentage rather than as a decimal. A equals the investor's risk aversion, where 1 is assigned to aggressive risk preference, 3 might represent an intermediate risk preference, etc. And sigma squared equals the variance of the expected return. Practical application question. How do professionals in the financial planning community ascertain the investor's risk aversion, or A? CFP and other professional financial planners use the risk tolerance questionnaire to assess and score the investor. Based on a series of questions, the client can be scored as on the conservative to moderate to aggressive spectrum. Content includes questions like, how much of your portfolio are you willing to put at risk in order to gain a 50% return? What is your primary objective? Conservation of capital? Moderate growth? Capital appreciation? What asset categories are you comfortable investing in? What are the implications of higher expected return, risk aversion, and variance in the utility scoring formula of ER minus 0.005 times A times the variance? 1. The higher the expected return of the investment, the better it is for the utility score. 2. The higher the investor's risk aversion, the more an investment is penalized for having higher volatility of return. And 3. The higher the variance, the more the investment's utility is penalized. The calculation resulting from this utility formula is the rate that the risk-free asset must offer in order to be considered attractive. In this example, you are given that the expected return of the security is 15%. The standard deviation of the return is 25%. And the investor has a moderate tolerance for risks, i.e. A equals 3. Calculating for utility, you discover that it is 5.62%. So, the certainty equivalent, i.e. the rate which an asset must offer with certainty, needs to be 5.62% or greater in order to be considered attractive as an alternative investment. The same process can be used to compare alternative portfolios. In this slide, you compare portfolio A with an expected return of 15%, a standard deviation of 25%, and portfolio B, expected return of 20%, standard deviation of 35%. Based on the utility formula ER minus 0.005 times A times the variance, you calculate utility of 5.62 or 5.62 utils. Calculating the utility for portfolio B, you find that it only offers 1.63 utils to the moderate investor. That means that portfolio A would be selected. Certainty equivalent analysis is appropriate for analyzing alternative investments for risk-averse investors because it scores investments according to optimal risk-return profile. It is not appropriate for risk-neutral or risk-loving investors, however. Return is all that matters for the risk-neutral investor. The corresponding risk is not a concern. For risk-loving investors, higher levels of risk have greater utility. So again, the risk-return profile is not a concern. The indifference curve describes an investor's risk-return preference. It quantifies the amount of return required by an investor for a given level of risk. For example, the investor might be willing to hold X units of risk in order to enjoy Y units of return. However, to hold twice as much risk, 2x, the investor demands 3 times as much return. How much excess expected return does the investor demand in order to hold risk of 3 times, or 4 times, or 5 times? As you discover the answer to those questions and plot the results, you construct the investor's indifference curve. The slope of an indifference curve describes the investor's risk aversion. For example, an investor requiring 3 units of excess return for holding 1 additional unit of risk, A equals 3, is more risk averse than one requiring 2 units of excess return for 1 unit of additional risk, A equals 2. In this lesson, you learned about expected return and standard deviation of a security, risk aversion, utility and certainty equivalence.